Well, the markets are kind of in a soup, if I could say so. That's because Asian markets are falling, and led by what's happening in edtech sector, the clampdown in China. Hong Kong markets also very sharply lower, so we are also catching cold. That's the kind of sentiment we are dealing with in today's market. However, it's not really falling off the cliff, just coming off is what we are actually observing as far as Indian markets are. Now, areas where numbers are good, quality still okay. Bajaj Finserv, Bajaj Finance, all of them are in the green, Tata Steel as well. But you can say banking and financials and pharma, these are two sectors which are coming under the weather. Krishna Sanghavi is joining us now on the show from Mahindra Manulife AMC. Krishna, good afternoon. Thank you so much for your time. Before we talk about valuations and pockets of value and areas, just wanted to get your thoughts on the way, because you have a global partner now. What kind of intelligence are you sharing or discussing within your research team and your friends on the other side regarding the kind of meltdown, clampdown happening in China, and which is also having a spillover effect in rest of Asia, including us? What are your thoughts there?
Sure. No, I think let's accept one thing. The financial markets are common across the world. Basically, same set of investors. We call them FPI, but net is a global investor looking to optimize or maximize their wealth across countries, across companies, across sectors. So the way to look at what's happening to China right now in last maybe 2 weeks or so on the the crackdown on maybe tech companies, etc. So there is a class of investor right in this world recently emerged as a ETF investors, or some people who actually are passive investors, not really taking a view on a company but taking a view on an index. I think for those set of people who invested, and let's not forget MSCI emerging market, China has a relevant share, almost 37% or so as we speak. As of June, and it was 37% or so. So to an extent, yes, there is that class of money which has chosen to invest in a passive way. They might look to review whether they want to be present in a particular index because of the heavy concentration there. To an extent, yeah, maybe other countries which are part of emerging markets can have a challenge, because let's not forget, the fund manager does not have a mandate to deviate to a different geography over and above the weight differential. So you has to represent the same country weight. Look at slightly medium term, which gets out of all this passive fund flows, and you have a different opportunity for India. In a way, the investors will get back to choosing companies, which is what we call active fund management. They will track the geographical growth, they will track the policy framework, and they will choose which companies are doing well. That's where this is, in a way, I can say from whatever we are hearing about this China plus one as a scheme from a PLI angle. Maybe Indian markets or a lot of Indian companies can emerge as a China plus one beneficiary on this count also.
Krishna, also, what we saw before this crackdown happened, the triggered fallout of this, before that, we saw a range of mid-caps, small caps going 4-5x, some not that backed by good fundamentals, quality management as well. On the other side, on the large caps, the picture which is playing out, or the scene which is playing out, is 40% of the weight, which is financial, is just not moving. Reliance Telecom, so over 50% is just not moving. For a average investor, bringing in kind of a mixed kind of a feeling that how exactly one should approach the market on valuation front, be it asset allocation front. What are your thoughts there? Or do you think in this the answer to this kind of dilemma for the investor is actually a multi-cap approach, which is also being called as flexi-cap? I think you guys are also working in that direction.
Yeah, clearly, I mean, one answer maybe is a flexible investing approach, which flexi-cap fund offers. The flexi-cap as a strategy really has an option to go large cap, go mid cap, go small cap in broadly any percentage allocation to the fund based on where the fund manager is more comfortable on, not only the large cap, mid cap, but even on the specific companies. So that's a space which obviously can help as far as creating a portfolio based on looking at bottom of stock selection, where we identify good companies and then, identify the right set of weights to be put into those companies based on the market cycle of large cap, mid cap, small cap. If you look at the last 10-15 year cycle, we've seen almost every year the leaders changes vis-a-vis large cap, mid cap, small cap. There are great years for large cap, followed by weak years for mid cap, and similarly true for small caps, where in one particular year, as you mentioned clearly, a lot of companies and even the index goes maybe more than 100% up, and maybe the year after perhaps it cools down, where some other market cap sector takes the lead. So that's broadly on what we think a flexible investment style which FlexiCap offers can be used for. Coming to valuations, yeah, clearly, finally markets are markets. There's always going to be pockets where you are comfortable with the companies because of not only the valuation but even the growth potential which the companies offer. So my own sense is that there is a selective opportunity available broadly across market cap, and that's where bottom up stock picking clearly helps. But yeah, on an aggregate basis, if I look at it, way the markets have moved in maybe last 12 months, 15 months, especially from the COVID lows. Today, on a relative basis, a large cap offers better risk reward equation.
Right. Krishna, what are your thoughts on this PLI opportunity-led universe of stocks? Consumer discretionary, pharma, is it chemicals, and even some of the smaller sectors like leather, shoe, footwear, all of that. Government is wanting to expand this PLI scheme. Does it open a big universe of investable stocks in the mid and small cap, or how are you analyzing this opportunity?
No, clearly, I think PLI is perhaps one of the game changer for Indian corporates and Indian economy. We've been talking about import substitution for a long period of time, but this particular policy really quantifies the benefit, makes Indian corporate create a viability that they know exactly the benefit they will get if they are able to produce goods for India as an import substitution. So for me, the PLI is really and the best part about PLI perhaps is that it's widely spread across sectors. There's no single sector which government has targeted. It's actually more like a bottom-up selection of every sector where India has been a big importer, and we can actually try and reduce the imports. Similarly, some of these companies are quality-wise far ahead, and if given some sort of a right support, right incentive in terms of revenue, some sort of a comfort of 3-5% of revenue being shared as an incentive for some 4-5 years. Some of these companies can actually change the track from being a pure import substitution player to an export growth opportunity, which is the second part, which is the China plus one again. That a lot of global companies and global countries are looking for an alternate option to some 5, 10, 15, 20% of supply dealing from China, more as their own diversification or a risk management strategies. So I believe this PLI in a concept is very useful, and because PLI is so widely spread over sectors, it is actually aimed at supporting or enabling Indian mid caps and small cap companies to take advantage far more than possibly for large caps.
Right. Krishna, before we wrap up, just wanted to get your thoughts on the fact that large portion of the market is actually sitting on very smart gains over the last 6-8 months, 1 year. Investors, what kind of red flags or some of the areas of caution would you like to bring on the table for people who are running mid-cap tilted portfolios or investors and traders at this juncture? Because there are 3-4 quarters of good growth on earnings front. It already happened. Bulk of the news is also starting to getting priced in. And there are some kind of, if not red flags, but amber on the horizon. What are those risks which you would like to highlight?
Sure. I think what we should monitor clearly is, there is a variable of global market integration. That's where US policy matters comes in. If you look at last maybe 10 years or so, US Fed has been clearly supporting the financial markets by way of easy monetary stance. And as while we speak, they have some stated view of holding this at least till CY22 and maybe some sort of a rate hike in 23. Let's see what happens there. Any change in stance from US Fed on its own monetary policy, that's one amber flag, I'll say, to monitor. And second is, what US government does to do a fiscal support review in September. Let's not forget they have launched some schemes to support, the unemployed people in US to come out of this COVID crisis by way of some, fixed weekly and monthly, remuneration. So they're going to review that in September. So if something changes there, that can possibly, clearly impact the growth of economy in US. And again, US being the largest economy in the world, drives all this pent-up demand across the world, which is what is happening. Coming to India specific, I think COVID is perhaps the single biggest, red flag, I'll say. While we are talking, COVID second phase broadly seems to be over, at least from a medical and government perspective. At the same time, they've been telling us that they are expecting third wave. No one knows the actual timing. So my red flag from Indian context really could be, if COVID resurfaces again, then it can delay the economic recovery which we are expecting, not only for country but even a lot of companies across the board.